Most people know they should start investing. They hear about it constantly, on social media, in videos, from successful people. And deep down, most people understand something important. If they want long-term wealth, they probably need to invest. But here's the problem. Most beginners feel overwhelmed before they even start. Stocks, ETFs, index funds, dividends, brokerage accounts, retirement accounts, risk, volatility. It feels complicated. And because it feels complicated, most people never begin. They stay stuck watching from the sidelines. So in this video, I'm going to break down investing in the simplest way possible. Step by step. No complicated language, no advanced strategies, just a complete beginner investing guide that actually makes sense. Quick note, if you want my exact stock picks, I give away 3 high-quality picks every month for free. Link in the description. Let's get into it. First, what is investing? Investing is simply using your money to buy assets that can grow over time. Instead of letting your money sit still, you put it to work. And over time, those investments may increase in value, or generate income, or both. That's how wealth is built. Not from one lucky investment, not from gambling, but from consistent ownership of growing assets over long periods. This is one of the biggest mindset shifts beginners need to make. Because most people think wealth comes from working harder forever. But real wealth is usually built through ownership. Ownership of businesses, ownership of investments, ownership of assets. That's what investing really is. Now here's something important. Investing is not gambling. A lot of beginners confuse the two. Gambling relies mostly on luck. Investing relies on ownership and long-term growth. When you buy a stock, you own a small part of a business. If that company grows, your investment can grow too. Now, of course, there's always risk. But long-term investing is very different from randomly placing bets. That distinction matters. Because if you approach investing emotionally like gambling, you'll usually make bad decisions. Now let's talk about one of the biggest myths in investing. You do not need a lot of money to start. This stops people constantly. They think, I'll start when I have more money. But waiting is one of the most expensive mistakes you can make. Because time matters more than amount. Let me explain. If 2 people invest, and one starts earlier with smaller amounts, that person can often end up with more money over time than someone who starts later with larger amounts. Why? Because of compounding. Compounding is one of the most powerful concepts in investing. Your money grows. Then those gains start generating gains too. And over long periods of time, that effect becomes massive. This is why starting early matters so much, even if the amount feels small. Now let's talk about the different types of investments beginners should understand. The first type is stocks. A stock represents ownership in a company. When you buy a stock, you become a shareholder. That means if the company grows and becomes more valuable, your shares may increase in value too. Some companies also pay dividends. These are payments made to shareholders. So not only can your investment grow, it can also generate income. Now stocks can be powerful investments, but they also fluctuate in price. This is normal. And beginners often panic when prices fall. But volatility is part of investing. The market moves. That's how it works. The second type of investment beginners should understand is index funds. This is one of the best starting points for most people. Instead of buying one company, you buy a collection of companies all at once. This creates diversification. And diversification reduces risk. For example, an S&P 500 index fund includes hundreds of major companies. So instead of relying on one business, you spread your investment across many businesses. This is why index funds are so popular. They're simple, diversified, and historically strong over long periods. Many successful investors use index funds because they remove complexity. The third type is ETFs. ETFs are similar to index funds. They allow you to invest in groups of assets, but they trade like stocks. Many beginners like ETFs because they're easy to buy and automatically diversified. Now, let's talk about risk. Every investment has risk. This is important to understand early. Stocks can go down, markets can fall, and sometimes those declines can be significant. This scares beginners. And when fear takes over, people make emotional decisions. They sell during downturns, then buy back later after prices rise again. This creates a cycle of buying high and selling low, which is exactly the opposite of what successful investors do. Long-term investors understand something important. Short-term volatility is normal. But historically, markets have grown over long periods. That's why patience matters so much. Now let's talk about mindset. Because investing is not just about money. It's about behavior. And behavior is what separates successful investors from unsuccessful ones. Most people fail because of emotions, fear, greed, impatience. When the market falls, fear takes over. When markets rise rapidly, greed takes over. This emotional cycle causes poor decisions. Successful investors stay calm. They stick to their plan, and they stay focused long-term. Now let's talk about how beginners should actually start investing. Step 1. Open a brokerage account. This is the account that allows you to buy investments. Today, there are many beginner-friendly platforms available, and opening an account is easier than ever. The important thing is simply getting started. Step 2. Choose a simple strategy. This is where beginners overcomplicate everything. They think they need advanced strategies, constant trading, perfect timing. But simple strategies often work best. For many beginners, index funds and ETFs are excellent starting points. Why? Because simplicity is easier to stick with, and consistency matters more than complexity. Step 3. Start small. Do not wait until you have thousands of dollars. Even small amounts matter. Because investing is not just about the amount, it's about building the habit. Once the habit exists, everything becomes easier. Step 4. Invest consistently. Consistency is one of the most important concepts in investing. Not timing, not luck. Consistency. Regular investing over time builds momentum. This is why many investors invest monthly or every paycheck. It removes emotion and creates discipline. Step 5. Think long-term. This is critical. Investing is not about getting rich quickly. That mindset causes mistakes. Real investing is about building wealth steadily over time. The people who usually succeed are the people who stay invested the longest. Now let's talk about mistakes beginners should avoid. Mistake number 1. Trying to get rich quickly. This leads to risky behavior. People chase trends, take risks they don't understand, and usually lose money. Mistake number 2. Trying to time the market. Nobody can consistently predict short-term market movements. Even professionals struggle with this. Focus on consistency instead. Mistake number 3. Following hype. If everyone is talking about something, you're probably late already. Successful investors focus on long-term value, not hype. Mistake number 4. Investing emotionally. Fear and greed destroy more portfolios than bad investments. Mistake number 5. Not starting. This is the biggest mistake of all. Because every year you wait, you lose time. And time is one of the most valuable advantages in investing. Now let's talk about financial freedom. This is why investing matters in the first place. Financial freedom happens when your income from assets covers your living expenses. That's the goal. And investing is one of the most powerful ways to build toward that. Not instantly, but steadily, over time. Now let's simplify everything. If you're a beginner, this is what I would focus on. Start small. Invest consistently. Keep your strategy simple. Think long-term. Control your emotions. And stay consistent. That's it. Investing does not need to be complicated. The people who usually win are not the people using the most advanced strategies. They're the people who stay consistent the longest. And if you want a simple starting point, I'm giving away my 3 free stock picks. 1 overall stock. Top fundamentals and technicals. 1 value stock. Great deal at its current price. And 1 high upside stock. Has the possibility to take off big time. They're selected through a rigorous process and designed to help beginners learn to evaluate investments. You can grab them through the link below. If you want simple investing strategies and step-by-step financial content that actually makes sense, subscribe to the channel. I'll show you exactly how to build wealth 1 step at a time.